Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for Wednesday, July 31st, 2019. So we've just wrapped up the last trading day of the month. We also have the big FOMC meeting out of the way, and I want to do a quick market recap. We don't need to go into too much detail. There are certainly some significant technical developments, hence the reason for this update. Members have been doing daily updates, intraday updates. I did an update after the FOMC meeting where Powell was still talking and answering questions to the press. This will be just sort of the end of day wrap, and I told you guys, members, I'll sharpen my pencil and get some targets out to you and levels on some of the things that we've been watching, like QQQ, XLK, the tech sector, semis, and all this good stuff. So let me start out just by preluding this video and repeating what I've said to members throughout the day today, and I say this I've been saying this for years. Anytime you have a potentially market-moving FOMC announcement, not all of them are that big a deal. Some are. Some announcements there's going to be no change in rates. Others there is going to be a change. Some it's not even about the change or lack of thereof, but what the Fed says. So we know lately the market has been largely, if not exclusively, driven by the Fed, and so therefore today, we saw some movement afterwards. But again, I call that post-FOMC noise, and what I'm referring to before we dive into the daily charts here, this is what I'm referring to. If we take a look at this chart here, let's go back. Let's do it like this. This is the 1 minute period chart of QQQ. So we're looking at right here. See this gap? There's yesterday's close. Let me mark it up for you. Let me tighten this up a little bit in time here. All right. So there we go. Yesterday's close. And let me do something here. Let me go like this. Okay. So this is what for most of the day the 1 minute chart looked like right here. I'm going to grab a tool. So there's yesterday's close. So we traded like this. There were a couple trading ops, day trading ops. And I was able to, get a few swings, trading NQ within the range, just a mean reversion trade before the FOMC announcement. The market's not going to go anywhere. So when it goes up, you're going to come down, go up, come down. And what happened is right after, here's my point, right immediately after this, see this first green candle right there? That is the 2 p.m. candle. So if you were, let's say, either day trading or you had some swing trade positions that with stops or price targets close by, what would have happened is, let's say you jumped on the initial reaction, you thought that was bullish, or you had a stop right here, it would have been clipped. So then the market reversed. So let's say you went long, seeing that's the 2 p.m. candle, the 1 minute candlestick. So you jumped in long, then you would have gotten burned. There's no way you wouldn't have got stopped out, especially if you're day trading on that big dip. So then you would have said, okay, well, now the market's going lower. They didn't like what they heard. And then it reversed. And again, so it's back and forth. And what I said in the video to members earlier today, what happens immediately in the wake of an FOMC meeting, and this went on for, by the way, there's, let's say 1 p.m. All the way over here. That's about, I'm sorry, 2 p.m. That's 2:36, so over half an hour of kind of indecision. And what I had said in the video, the update to members earlier today was, you remember the stock market and what is going on today, immediately after the announcement. It's a compilation of millions of market participants, both human and non-human, because they're, the majority of trading nowadays is done by electronic trading, algorithmic trading programs, high frequency trading. The algos will instantly parse the Fed statement before you or I can before a human can read it. They run through there in milliseconds looking for keywords, key phrases, things like that. And so you have the algos, the computers, the machines battling. You have individuals trying to figure out, okay, what did that mean? Where are we going from here? Then, of course, you have the press conference that goes on for a while, and Powell may say some things that may move the market as well. So can't say this enough, and I probably beat a dead horse here, but I say it all the time. Don't try to make heads or tails of what this is. Don't assume that the initial rip or dip or even the subsequent rips or dips mean anything. But after a while, once everybody's kind of parsed all the data and had time to process it, sooner or later the market picks a direction. And you can see as time went on, it picked a sharp leg down. And this is when I did the video. And then we had a pretty sharp, not equally sharp, but and not equally as strong on the way up, but another kickback rally. So again, point is, this is post FOMC noise, and that's a big range. So my point again is, I like to, another thing I say, if I have swing trade positions coming into an FOMC announcement, what I'll do is, if my trade is close to its price targets, I'm going to leave those in place. Why? Because let's just say I had a short trade. I want my price targets to be filled. My goal on any trade, any swing trade, is to not be stopped out for a loss. It's to be filled at my price target for a profit. So therefore, I will often suspend stops if they're close by in this, to avoid getting chopped out in what I call the post FOMC noise. But if a trade goes on and spikes into up or down into my price target and and it gets filled, great. That's what I wanted. I'm out of the trade. That was part of my trading plan. Anything that happens afterwards isn't going to change my trading plan. So I wanted to share that little tidbit. And then now let's look at what happened. So we didn't recover all the drop, and not even close. We still closed down 1.34. So now let's dig into the good stuff. That's just kind of takeaways, things I've learned the hard way over the years trading, trying to get in front, or trying to make heads or tails of what I call, again, post FOMC noise. It's no other, it's the only term I can give it. So now, as time goes on throughout the day, we've had a couple hours of trading, and you can kind of see where the market's hand was tipped. I will say this, that sometimes it takes a day or two. This reaction, I can't tell you with the highest degree of confidence it will stick. It's still a little suspect. You have to take it, these breakdowns, with a grain of salt. But with that being said, it was not just that we went down 1.34. We have been pricing in a correction for quite some time with these divergences building. And as I said here recently, most recently I was watching these trend lines I'm going to show you here on QQQ. That was smashed through. We have a solid red candle. The momentum fueled overshoot took us down through. We had a lot of momentum. The market was going almost straight down. We overshot that 190, 146-ish. And remember, it's not a hard line, but that's roughly where those previous highs were on QQQ. So we essentially came in for a back test. We closed a little bit below it, puts QQQ in a slightly precarious position. But again, with the big moves, it's not uncommon to see levels overshot. But the most important thing is this breakdown wasn't even close. If we closed just a hair below the trend line, I would say, nah, you just have to give it the benefit of the doubt. You still have to question it a little bit, because it is still, we're in the only 2 hours past the meeting, since the market closed. So let's see how this holds tomorrow. But as of now, and I said this in the other video earlier today, sometimes you just have to take things on face value. And this is a breakdown, any way you want to slice it or dice it. Yeah, is it a little bit suspect because of the Fed announcement and induced it? Maybe it's an overreaction. Possibly, quite possibly. And that's what I said to members. Look, I'm not putting this on as a QQQ as an official trade, but I can tell you I'm certainly short and added to it, and with what I saw today, and we'll take that home. And I think it makes sense right now to at least have a starter position based on this breakdown. You don't have to go all in, because again, it's not an all-in sell signal. It is a sell signal. Big bearish candle right there, and so we'll see how we trade tomorrow. So there's a lot of scenarios here, but again, we've had just mounting bearish evidence, the recent bearish PPO crossover, the negative divergences, now the breakdown. That's the sell signal. Before, I can talk a bearish talk for 3 days, 3 months, or 3 years, depending on what the pattern and time frame I'm trading. Pointing out, red flags, divergences, trend lines, uptrend lines, bearish patterns. But until you have a sell signal, there's a big difference between a trade setup and an actionable trade. This is actionable right now. Again, maybe not a full position to play it safe. See what happens tomorrow. A couple ways. Bounce, kick back to back test the wedge would certainly be objective, with a stop somewhat above. Solid daily close above this trend line would certainly muddle up the bearish case, if you will. So as long as we remain below there, even if we back test, bulls want to see this 190, 146-ish level hold. Bears want to see it taken out. If we can take that out with conviction soon, whether we backtest or not, there's not a whole lot. Again, I told you guys, members at least, I'm going to sharpen my pencil, but I can tell you, right, there's a little bit, there's support right there, cluster of candles and a gap right there, and then 185-ish. Again, rough targets right now. But more importantly, based on the scope of the pattern, it projects for a whole lot more than a quick 3-4% correction or pullback trade. It projects, in fact, more than this right now. So there is the potential, for the same thing I've been talking about since about midway through here, when I flipped from bullish and long to bearish, looking for the next leg down. We're not that much higher at this point, and so the potential downside that I can see from here, if this starts to play out and then the weekly charts continue to firm up for the bullish case, the monthly charts as well, we're talking 25+% downside potential. And that's just a potential right now. Please don't misunderstand me. Don't get ahead of it. Let's not get ahead of ourselves. I need confirmation. We need to see more than just one red candle breakdown. We need to, first of all, see this stick, because again, it's a little bit suspect. Because that was induced with the post FOMC noise. But again, it did some technical damage. That's a big red candle. So enough on that. And SPY, let me just hit that real quick. Same story. That's that same wedge right here. Let me make clear if you haven't caught up on my recent analysis. This is the trend line I've been watching most recently. Solid break and close below it. In other words, we didn't close right back up on there. That's the important thing. So there's your wedge, there's the breakdown. SPY has plenty of work to do. For the bullish case, this could be nothing more than we may come a little lower, back test that key 294 level on SPY. That was this, we had a couple highs back here from October. Then we also had highs back here in April. Then we finally broke out. So right now, if you want to just, take this for what it is, you have a breakout in the S&P 500 right here. That is still intact and will be as long as prices remain above 294. If we dip below there intraday or a day or two and snap back up, that's still fine for the bullish case. That is not my preferred scenario. It's not what I think will happen, but if it does, then it's going to foil the bearish case and strengthen the bullish case. What the bears want to see, and position short, what I want to see is a solid breakdown below and close down below 294. I want to see impulsive selling, and if so, then I will increase short exposure. If not, I'll just kind of sit tight for now, see how the next day or so plays out. But I just wanted to confirm that is a sell signal, but we need still pending a little bit more to increase the chances that it's not going to prove to be a false or whipsaw signal. Here's a 60-minute chart on SPY. You can see, same thing. I showed you we're basically right at about some horizontal price support there. I have it about 296.61 here, and that's where we close the day. So, pretty much to be continued tomorrow. But I want to show you guys one more chart. Talked about this quite a bit. As I said, until and unless tech breaks, the market doesn't break, because tech is the largest component, largest sector in the S&P 500, largest sector by far in the NASDAQ 100, and the market will not go down without the technology sector going down. It won't go down substantially, I should say. So what do we have today? Well, a solid and unambiguous breakdown right there. Big red candle. That's that same wedge trend line that I've been more of a contracting price channel right there. There's your divergence right there, negative divergence, and that's about as good as a sell signal gets. The only thing it could be a little better is if today wasn't a Fed day. You have increased volume expansion. I like to see that on breakouts above average volume. I like to see impulsive selling and a solid close below the trend line or whatever pattern I'm looking at breaking. So that's what we have. That is a sell signal. On the flip side, there's some work to be done. There's your previous reaction high. Just gave you a line from back in May, and so we came and almost hit that. Maybe tomorrow we hit it and bounce, and if so, then there's the potential for a rally. that could continue to extend these divergences. Not going to change anything from my longer term outlook. Near term, might foil it. I'd prefer to see a breakdown here, but even if we kick up a little higher, it's just going to extend that divergent high. So I'll be talking about the same intermediate and longer term outlook let's say a week, 2 weeks from now, if we happen to kick up and go make a marginal new high. Eventually maybe we burn through these divergences by taking out the previous highs, in which case then my outlook would most likely change. But as I was persistent and adamant back here all this way up, saying until tech breaks, the market won't break, but when tech breaks, the market will break. There was our sell signal. That led to the biggest drop that we've had in the tech sector and the stock market throughout the entire bull market in over a decade. And that was clearly outlined back then, and I said the same thing here. I had a very clean uptrend line on XLK. When tech breaks, the market breaks. There it was. Biggest correction in 2019 so far, and this is our third time now in the last almost a year that I've been looking for that. And so we have the sell signal. This time, or those other times, we didn't really have a horizontal support below to. We had some minor support right there. Yeah, I'll give it credit. There was some support. It wasn't as well defined. This is a pretty important level, just like the levels I showed you on QQQ and SPY. So that's why I'm saying these are sell signals, but not what I call all-in sell signals. Get a starter position going if you are bearish and you think we're going lower, or hold off and then wait to see these levels get taken out and get taken out with conviction, meaning impulsively solid closes below, and then that should open the door for the next leg down. Okay, and to wrap this up, and more so for the public YouTube subscribers, I really appreciate the support for everybody out there that not a member of the site but follows the YouTube channel on the public content. Keep in mind, all I do is broad market analysis. Occasionally, if I cover a sector or something like treasury bonds, it's only because it ties into general stock market analysis. But the bulk of my trades and the trade ideas on the site are not the stock market. I always say this: if you want to beat the stock market, some people can do it by trading the market, but that's really hard. Why try to force trades on the S&P 500, 500 stocks, 500 companies? If you go long the SPY, you're going long the most bullish and the most bearish stocks and sectors in the stock market or in the S&P 500. So it can be tough. So I like trading individual stocks, sectors, commodities, precious metals, wherever the opportunities are. Today, for example, before the market opened, followed up. I've been highlighting actually what I've been highlighting in recent videos was this price channel in natural gas. All the way since back right here when we were here, I said a break above this downtrend line would trigger a buy signal. We hit it, kept testing, moved down, fell to support, highlighted it last night here, reiterating that we had nice bullish divergences, and again this morning before the market opened, an hour or so, posted this chart right here on the site. That was UGAS poised for a 13 to 27% rally, showing this chart posted, screenshot taken at 8:22 in the morning. Said it looks poised to break out, trigger a long entry on a break above there, and gave you targets. And also for those that don't trade futures, said same thing in UGAS, 1443 first target, 1625 the second target. And so my point to this is that about trading the stock market, as big as today was, here's a simple trade, just one trade in one day that's made, it's up 14%. Where it was trading pre-market from the highs, it was actually, it was close to that because we gave up some of the highs. We rallied about 18% off today at the peak. Over 10% of that was just from where we broke out, where futures broke out, and I said UGAS was trading liquid, was liquid and actively trading in pre-market. It only had a 1 to 3 cent spread at the time, so you could have taken this in pre-market if you don't trade futures. And then the point is, so you're talking 5% minimum on I think it was on natural gas on the futures. And when you go back, here's what I wanted to point out. I keep saying this. When you go back to the S&P 500, so in a single day, you look at the S&P 500, what it's done in a single day on just one trade. we're able to make more than the S&P 500 has gained in a year and a half. That's the January 2018 high. It's almost a year and a half ago, and that's where we are today. There's we closed today. We're up about approximately to today's close about less than 4%. So there's been trading ops. Don't get me wrong in the market, but as far as buy and hold goes, buy and hold's done in my opinion. Buy and hold this probably just came off the best buy and hold market ever from 2009 to about right here at about the 2018 highs. And since then, this market has traded sideways. There's been big trading ops, and volatility's been low lately, but we're primed. Right now, the technicals are indicating that the next drop may be here soon. So, and I'll end this with just the final thing that I talk about all the time. I continue to get new people into the site, both as customers or those following the YouTube channel, and it's all about asset allocation. Although if you're only a public YouTube follower, or you come into the site, read the public content, which is mostly the general market analysis, also some extra things besides what's posted on the YouTube channel, that the stock market itself or equity should be a sliver of the pie of your portfolio. I mean, this is asset allocation model, and it changes throughout time, and it's going to change for everybody, but you're going to have a certain portion in stocks, a certain portion in gold and precious metals, mining stocks, commodities, wheat, coffee, grains, natural gas, depending. And again, I move around a lot as an active trader. Treasury bonds at the right time. Most of the year we were long in bullish treasuries until recently they've stalled out. But this is what trading is all about. Whether you're an active trader or an investor, I think that asset allocation and diversification is very important. So again, stock market now, in the next couple months here, may make up a bigger percentage of my holdings if we get those sell signals on the short side. If we don't, that's fine. I'm not going to go long to leave my money in a virtually a trade that's just crawling up. I'll just prefer to strategically move around to wherever the best opportunities are. Individual sectors, individual stocks, both long and short, individual commodities, precious metals, bonds, etc. All right, we'll wrap it up here and pick it up tomorrow. Let's see how we follow through. But as of now, like I said, I will not mix words. Pretty good sell signals on the market, and a little more work. If we can get a little more downside, just a couple percentage points, and close down below these levels, especially impulsively. It's how we close below them. Then we should firm up those sell signals, and that could set the stage for another, a tradable trend, whether it's 5, 6, 7% or a lot more. So we'll just have to kind of assess the charts as we go here over the next few weeks. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.